Hey everyone, welcome to the webinar. Glad you hung around. We're going to get together tonight and build a system completely from scratch. And we're going to talk about some numbers. We're going to do a whole bunch of things, but the goal here tonight for me is to leave you with something that you can use going forward, something that may actually change your trading life starting tomorrow. It's the old give a person a fish or teach a person to fish. We're going to try to teach tonight. We have lofty goals set for tonight, so let's get to it. First of all, of course, I am going to give you some numbers at the end. These are hypothetical numbers, not taken from a live trading account. Please do not risk any money you cannot afford to lose. Do my best to make accurate numbers and accurate representations, but again, they are hypothetical. All right, 3 things we're going to do tonight. Like I said, we're literally going to try to build a system from scratch, right? How are we going to do that? Well, we're going to build from ideas first, which some of the greatest traders in the world, that's what they do. We're going to do that tonight. And then we're going to find out, okay, fine, these are good ideas. Does it beat the market? Because for me, if you're going to trade, you might as well beat the market, right? I mean, if you're not going to beat the market, then just buy a Vanguard index fund or do whatever you need to do and go sit on a beach and make your 5, 6, 7% per year, right? We got to try to beat the market. So hopefully we're going to build something that makes sense, but most importantly, we want it to work, okay? So if you're here listening to me tonight, if you saw the title, you might be a complete beginner. You might just be, I don't even know what to do. Maybe you got interested in trading. Maybe you just got some money in your pocket which is how I started. Just started to make some money, saw my bank account grow, and it's like, I don't want to buy an index fund. I want to do something with my money. Maybe that's you, or maybe you've been trading for a while and it's just not going great, right? A lot of traders fail. Those magic stats that they always give you, 80%, 90%, 95% of traders fail. I don't know if any of those are true, but it feels true. So maybe you need a place to start. You don't even know what to do. Well, tonight we're going to try to give you something to do, all right? There are three really big ways that you could go about this if you're really starting out tonight, and that is you could buy something. I could give you a flashy presentation. I could give you a bunch of upsells. I could give you a bunch of bells and whistles, whatever, and I could try to get you to buy. Now, that actually does work. There are good people out there selling you good stuff, and it works. But it also doesn't work. People try to sell stuff, and they're mostly marketing and not trading. It happens, right? It happens in every business, not just online education and online trading. But if you buy something, it feels risky, and we're going to talk about those risks in a second. Or you could buy a really fast computer, and you could try to data mine something, and we'll talk about what that means. Or you could build something, like that's what we're doing tonight. All right, obviously the problem if you're going to buy something, first big problem is a black box. All right, I'm going to show you, you can buy the system from me. I automated it, so it's either me or someone else. Is it a black box? Well, tonight you're going to know everything about the system, so it's not a black box. But if someone's online, they're selling you something, and here are the results, but I can't tell you how, it's proprietary, well, there's a problem with that, right? If they don't give you any back testing, if they don't give you any past results, if they don't give you any live trades, we got trouble. If you don't understand how it trades, then guess what? At the very first losing streak, you're gone, right? So that's where you fail. If you're going to be a data miner, you're just running, say, listen, I'm going to check every minute of every day in the Forex market, futures market, stock, I'm going to check everything and try to find something that works. And you come up with some anomaly like Tuesdays at 12:30 goes short when it's raining. Well, there's data that can give you that, right? It's like the Bangladeshi butter. Remember that old test? There's something about that. If the prices in Bangladesh butter went up, the stock market went up. I'm not getting that exactly right, but it was right like 99% of the time. Crazy. That's data mining. It's not really effective because, again, if Tuesdays at noon shorting doesn't work a couple times, where's your confidence level, right? So we're not going to do either one of those, right? We're going to build it from scratch, and that's where ideas come from, okay? We don't want it to be a black box. If there's no black boxes, there's no charlatans, there's no one stealing your money, there's no trickery, right? And we want this to work going forward. We're going to put good ideas on the table. We're going to try to put good ideas to work, ideas that are true today, that are true 100 years ago, going to be true 10, 20, 30 years from now. It's a lot to do in just a Tuesday night webinar, but we're going to try. But if you use logic, if you tell a good story that makes sense at first, there's no reason why a timeless principle, a logical principle, will stop working. So let's start with an idea. Who else did this, by the way? Jim Simons, the best trader of all time. If you check the numbers, better than Buffett, way better than everyone else. He started most of his systems with a story, right? Now he does a lot of things, but for the early part of his career, when he made a bunch of his money, he started with a story. So that's what we're going to do. We're going to start with a story / a principle. What principle is true today and will be true tomorrow? Well, trend following is one. Follow the trend. Trends are eternal. Trends will always exist. They will never go out of style. They will always be there. There's a problem with trend following though. Now, a lot of people do it in various forms, but a lot of times they massage it, right? A lot of times they don't trade it, quote unquote, pure trend following. Why? Because pure trend following is really, really hard. If you like to look around at different systems and you try a little bit of this, a little bit of that, trend following will not win. It will not work for you. Trend following stops out a lot. Trend following is buying at the high. Trend following has a lot of problems that are not pleasing. If you're looking for big win percentages and a lot of fun action, trend following, long-term especially, is not it. So we're not going to talk about that tonight. We're going to talk about value investing. We're going to go Buffett style, right? We're going to buy something on sale. When is buying something quality on sale ever not going to work? Well, it's always going to work. So trend following will always work too, by the way. Research on that, but we can talk about that some other time. But tonight we're going to do value investing. Why? Because it's timeless, but also because you might actually want to do it. If you're trend following, what does that mean? You're buying at the high. It is not fun to buy at the high. Well, it's been fun in the stock market for a few months now, but you feel like an idiot. If you buy at the high and it immediately turns around, of course it wasn't going to go up. It was overbought. This is really, really hard. Now, value investing is really, really fun, right? It's fun to say, oh, look, I bought it on sale. Everybody loves a deal. Right? Home Shopping Network exists because everybody thinks they're getting a deal and they love it. Value investing is the same way, because if something goes down and you bought it, if you started buying in March of 2020, you look like an absolute genius and you've got more Twitter followers now and you are bragging on the daily basis. Why? Because value investing, buying at the lows, makes you smart, makes you feel good, right? And it also gives you a way out. It also gives you an excuse. Well, it wasn't my fault. I mean, its value is 100. I know I bought it at 50 and it went down, but it's not my fault, the economy or something else, right? Or you could say, well, I was right, but I was early, right? Psychologically, it makes sense logically, but psychologically, it's very, very sustainable and very, very fun, right? So now we know why. Again, these are the nuts and bolts. This is what we got to hammer in place before we get to the facts and figures. So we're going to choose value investing now. Great. What are we going to trade? There's a lot out there. What are we going to trade? Well, stocks, again, it's been fun since March, but it wasn't fun in February and the beginning of March, right? Plus, if you're going to start tomorrow, if you listen to a webinar and you're going to start tomorrow, I mean, good luck, right? Okay, well, what do you trade? Do you trade ETFs? Do you trade 8,000, 10,000 stocks? Do you trade penny stocks? I mean, there's nothing that's really easy or shouting and saying, okay, do this, buy this. You're gonna go do it on Apple? We can't buy Apple on sale. Apple hasn't gone down in 40 years. Exaggerating, of course, but Apple only goes up now. So how can you buy Apple on sale? See what I mean? Stocks are difficult. Well, we could do futures. A lot of history in futures. And that gets us down to really 50. I mean, there are more futures than that, but it gets us down to a more manageable number. But man, if you have not traded futures, it can be daunting, right? You've got the rollover, right? Every few months, you're going to have soybeans delivered to your door unless you roll it over, which means you got to get out of your position and get in the new position and find the new contract. It's complicated. I mean, it's not something probably you'd be able to do tomorrow. Maybe you're smart, but it's also still 50 things to choose from. So tonight we're going to use Forex, which in itself, makes people nervous, but honestly, it's much more simple. It's much easier because we're just going to use the big three. In the currency world, and I've been in the currency world since 2009, heavy, every day since 2009, dealing with programs and robots and discretionary trading. There's really the big three. They're the most popular, they have the most volume, they react well to different programs, different systems. So really, we're down to three, right? So instead of 8,000 or 50 with rollover, now we're down to three. But we're going to go even easier than that. If you knew anything about currencies, what's the most popular one? It's Eurodollar, right? I mean, if you turn on CNBC, you won't see a lot of Forex, but what you will see is the euro, or the dollar. Pretty much everyone's heard of Europe and everyone's heard of the United States. And we pretty much get news from Europe, so we can kind of feel like we're in the know. And of course, if you live in the United States, you get news from the United States too. So it's not trading like the Aussie dollar and the Japanese yen, like what, it's so far out there. Euro dollar is, maybe you visited Europe, right? So it's one of the big three. It's got the big volume. It reacts well to systems. We're just going to choose that. Okay, easy, right? I gave you something. There you go. We're moving along in the world, right? So we're going to start with the euro dollar. And by the way, the other two of the big three are the pound dollar, British pound, right? That's kind of Europe-y, and the dollar yen, which is big volume. Maybe not quite as popular as the other two, but those are the big three for me. You can trade Forex and never really deviate from those three and do just fine. All right. It's not easy to make these rules, right? I want to get to the charts, but to make this system from scratch, we got to have ideas and then we got to put rules on them. All right, we're going to use value. We got to have fair value. How do we know it's on sale if we don't know the value, right? So we need fair value. I mean, who determines that? We're going to find a newsletter to read? No, we have to be able to do it on our own. We can't rely on anyone else. So we need fair value. So what do we do? Well, a couple things you could do, but I'm offering you one tonight, weekly pivot points. Okay, what's a weekly pivot point? Weekly pivot points have been around forever. So I love things that have been around forever. How do you know something's going to be around tomorrow? It's already been around for a long time. The classic books sell hundreds of thousands of copies every year, okay? So weekly pivots have been around, they're going to be around, they're going to be good for many years to come. Well, what is a weekly pivot? Well, you take last week's prices and you go the high plus the low plus the close and divide it by 3. Now you could do that by hand. Just what's the high of last week? What's the low of last week? What's the close of last week? And you can see what it's doing there. A weekly pivot point is giving us equilibrium. It's giving us fair value. You take the high, that's as crazy as it got. You take the low, that's as sad as it got. And then you take the close. Okay, well, that's where it ended the week, right? Somewhere in the middle of all of that is normalcy, fair value, right? And it doesn't ever move, so we can trade to it. Now we could trade to a moving average, but that moves. Moving average is almost never the same. So we set our profit target at a moving average and then it moves. Then what do we do, right? A weekly pivot is something that once we determine our trade, we can trade to it. It will never, ever leave us. We can trade to this level for days, weeks, months, years, okay? Furthermore, price touches the weekly pivot almost every week. Almost every week. I mean, a crazy amount. And it usually touches it right away. Usually touches it right away on Monday, right? Just things run right back to fair value, right? We've had last week, we're trading, all this stuff, all this news. Price, listen, hey, let's get back to normalcy, right? Reverting to the mean is timeless. It will never go out of style either. So price touches weekly pivots. As far as touching them at any point, it's near 100% of the time. If you're trading long on the SPY or any stock index, 100% of the weekly pivots, if you're trading long, have been touched. Okay. Same thing in Forex, same thing in futures, right? Weekly pivots are touched because it's equilibrium. It's a universal concept. Of course, it's going to get touched. Don't trust me, do your own research, but put your weekly pivots on a chart, and they should come with every platform. I haven't seen a platform without them in a while. Put them on the chart and see when price touches it. Touches it meaning just touches it, okay? All right. How do we know then we're getting a deal? If we're going to use weekly pivots as fair value, how do we know we're going to get a deal? Well, It's got to be way below fair value, right? It's got to be 50% off, right? That's our example, or it's got to be way above. One of the two. It's got to be extreme. So you see where we're headed, right? We got fair value, we got price going way above or way below, and then we're going to trade back to it. So we got a concept that when is this ever going to go out of style? Again, the answer is never. I mean, if you only bought houses that were on sale that you knew what they were worth, right? So it's moved a long way away from fair value. Great. What does that mean? You see, it's hard to make these rules. Concept, long way, yeah, it makes sense, but it's hard to make rules. Well, how about a day's work? How about a day's travel? That is what we'll call a long way away, right? Let's say that in normal days, it's not going to go all in one direction. It's going to kind of swivel back and forth around the pivot point. Touch, 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 touch. But let's use some numbers. All right, so an instrument normally moves 100 pips total in a day. 100 points, 100 pips, whatever you want to say. It goes up 100 or goes up 30, then it goes down 40, then it comes back up, right? And the total from high to low is about 100 points. Okay, so if it goes a whole day's average away from fair value, something's going on, right? It shouldn't do its whole day's journey in one direction away from equilibrium, away from fair value. It shouldn't do that, right? Unless something is going crazy. So finally we get to a picture, and here's an example of what I mean. This green line on the chart, that's a weekly pivot. The platform just plugs that in for me. Now, have I calculated these manually? Of course I have, and I've done it many times. You can just take the high, the low, and the close, calculate it, divide by 3, and then just draw this horizontal line. And this line is good all week. In fact, it's good for much longer than a week. And here's an example. Price, see, it's kind of moving around. This is from last week. A new week starts, and then it starts to run like crazy in one direction. It normally does this, right? And this is a live trade that I actually took on my real account with real money from 2020, not that long ago in August. But you see, this is what it normally does. This is not normal, right? So, if this is fair value and it's going crazy, that is extreme. We're ready for something to come back toward fair value, and lo and behold, it did. That was a winning trade, okay? Let's go back. Price got emotional, price calmed down, and then price ran right back, okay? Instead of just being around equilibrium, little bit up, little bit down, nope. It went crazy in one direction, a whole day's worth of movement. And so we set up a trade, and you saw how it turned out. Again, though, we got to quantify this, right? We can't just have vague concepts. We need numbers. So to quantify this quote unquote long way, we're going to use average true range. And a lot of traders love ATR. I am no different. Average true ranges, it moves 100 points on average for the past 14 days, for the past 20 days, whatever, right? You can use any length you want. I tend to use 14 or 20. I think I use 20 for this example. Not a big difference. But it just gives you an average of what's extreme. What if it moves a full day's work, that's extreme, and this tells you what a full day's work is. Okay, so now we're getting closer to our system, and it's coming, it's right around the corner. But let's summarize where we're at, okay? We want to choose a timeless principle, and we did. We picked value investing because it's fun. It's fun to say you're right. We're gonna choose an instrument that doesn't give us a lot of choices, which happened to be Forex, which happened to be the big three, which specifically was the euro dollar. We needed to have a fair value that we trust, and weekly pivot is the most trustworthy proxy of fair value that I've ever found. You might have your own, and it doesn't move though, which makes it beat moving averages, which I also do love. And then we want to initiate trades when prices move far away. We either buy it when it's, or sell it when it's too extreme, and buy it when it's down on sale, so to speak. So that means we're going to use the euro dollar of the big three. We're going to trade back to the missed, in italics, weekly pivot, and we're going to wait for it to get an average true range length away. Gosh darn it, one more thing, right? It's hard learning stuff. What is a missed pivot? Oh, well, I'll be happy to show you. Missed pivots are very powerful, right? Pivots in general are great levels, don't get me wrong, but the percentages of price touching a weekly pivot in general, or specifically in the week that it was created, the likelihood is extremely high. We're talking 70, 80, 90%, depending on your instrument. You can see that in our example, price did make it back to the weekly pivot. Almost exactly. Is that spooky? It's a little bit spooky, right? Price got extreme and it needed to correct. Well, where did it correct to? Dun, 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 the weekly pivot. And then right here, price, oh, we got extreme again. Guess where it went to? It needed to get back to equilibrium. Where is equilibrium? The weekly pivot. Put this on your charts. Look at them. It's creepy. Okay? Creepy. Now, if it's touched, if this had been touched before our trade, we would have left it alone. We don't need it. Why? It's already done it. We're looking for equilibrium to be necessary and to get more and more and more necessary as price gets extreme. We know it always touches. If it doesn't touch, then it's due. If it's already touched, we're going to let it go. Okay? So for example, this one is not a trade. Once it hits the pivot, we just leave it alone. Okay? It has to be missed. It has to be untouched. That's when we know it's even more extreme. Untouched pivots, ATR away. Got it? So we'll just leave it alone. Now I look back, I didn't want something that's recent. I wanted something that goes back, that has history. So over the past several years, I looked up the euro dollar, I looked at its average true range, and it's about 80 points, 80 pips. That's typically what it moved. Now it changes. Average true range always changes, but that's very typical, all right, of the past number of years. That's fine, right? I don't care if it's 82 or if it's 91 or if it's 78. That's 80 is fine, okay? And that's all you have to do. If you're gonna do this on your own, just get close. It's been this number for a number of years, that's fine, okay? So if we waited for it to get 80 points away, that'd be okay, right? The foreshadowing of what's to come. That would be okay, but let's get an even more extreme, right? If we wait even longer, maybe our percentages will go up. At least that's the thinking. Instead of waiting for 50% on sale, what if we waited for 55% on sale? Maybe that's a better trade, okay? So we're gonna take ATR, multiply it by 1.5, just a little bit more than the average true range, and that's 120 pips. 1.5 times 80 is 120. So we're almost done. 120 pips away starts the trade. If it's untouched and it's extreme and it's 120 pips away, we're ready to go. And this, whether you didn't know that, but that's what happened. This is fine here, it's untouched. It eventually got, and my robot waits for it to get 120 pips away. And then this big push here, it got your 120 pips away. And once it goes away, it measures it for me. You could just put a line there and then you'd know, right? I've done that too manually. Once it gets away, then any break below this level, once it gets away, starts to trade. And that's what happened here. Once it gets below the level, it goes. Now it can be done automated or you can do it yourself, okay? If it were a long trade, it would be the opposite, obviously, okay? All right, we're gonna trade. What are we trading to? Well, we could be greedy and say, let's make it get all the way back to the pivot. I know it touches it, let's make it get all the way back. But we're not gonna be greedy, okay? We're gonna just make it go one ATR. We're gonna take it. If it normally goes to the pivot and we just make it go a little less than that, that's even better. Our percentages hopefully will rise. Okay, so we got that. Now we need a stop loss. Man, we're learning a lot. We need a stop loss. Well, when we start this trade, it's an emotional time. Price has moved far away from where it's supposed to be. it might keep going. We might be in the middle of a freight train. It could happen. This could be a start of a savage trend. Though sometimes they're losing trades. It happens. But we're going to give it room. We're going to give the adults in the room time to get in there and send it back to the weekly pivot. So we're going to give it 1.5 again. Got it? We're going to give it plenty of room to work out. I know it's an inverse risk to reward. Probably won't work, but we'll see. And last, what about break even? Well, not quite last. What about break even? It's hard. Let's say we set up a trade, we're going for 80 pips, and we get to 70. And then it turns around and stops us out 120 pips from our entry. Let's move 190 pips. That would be so frustrating. So for me, if I'm going to trade to a big profit target, I prefer break evens because I'm weak and pitiful, but I like it. So we're going to put a break even in. Now, break evens almost always lessen profit. We're just going to have to deal with it. For our psychological purposes, we're going to put it at 70, okay? And I'll summarize this in a second. Last thing, when is this trade most potent? If I had you guess at which day, it would be Monday/Sunday, right? Forex market opens up again on Sundays. If things got emotional over the weekend and traders are worried by the positions, or news comes out, people are going to want to get in the market right away and get it back to fair value. Get out of this trade. Monday, you could trade the system, and I've done research on it, on just Sunday, Monday, and you can make money. But what about the rest of the days? Well, if Monday is panic, get me out of these trades or whatever, what's Tuesday? Tuesday is the opposite, at least in my mind. If Monday is get me out, Tuesday is we're going back the other way. If Monday is I got to get in, Tuesday is whoa, I got to get out. If Monday is desperate, Tuesday is an immediate reaction. So I didn't trade on Tuesdays in this particular system. Put Tuesdays in if you like it. But you know what's interesting is that Tuesday trading on a reversion to the mean is not great. The data said it, but our idea said it first, okay? So here it is. Here's your system. You waited so long and you were so patient. Enter the trade at 120 pips. You know why we do it then, right? We spend a lot of time on why. Our target's 80 pips, our stop is 120 pips. We're going to move to break even at 70 pips of profit to save our psyche. We're not going to trade on Tuesdays to avoid the overreaction. Okay, we built something from scratch. Does it work? Well, from 2008, I ran this little test on the euro dollar. 2008, I traded one lot each time. There are the numbers. You can see the data is 99.9% accurate. That makes me feel good. There's your drawdown, there's your absolute drawdown, and there are all the facts and figures, right? How does that look to you? Well, you might be picky and you might be able to find a black box online that does much better, but we feel pretty good about this lasting into the future. And honestly, I feel pretty good about what I see on the screen. And there we go. $48,999 of profit. Trading costs are built in, by the way. There are some in Forex. Max drawdown, 8,400. Win percentage, about 65, a little bit higher than that. It's nice, right? It's nice to win that much. Now, big number here is absolute drawdown. Starting in January 2008, the worst our account ever would have seen drop, the worst drop our account ever would have seen was 38.91. So a 38.9% drawdown. Now, the max drawdown was bigger than that, but that max drawdown happened after we had already made a chunk of profit. So yes, we would have lost that number, but from zero, from the get-go, from January 2008, that's the worst we saw. In trading during the financial crisis, if we only saw a 38.9% drop, that's better than what the index funds had, right? So just throwing that out there, that's what absolute drawdown means, okay? 38% drawdown in March, right? Just about. So, you know, it's what happened in March. That happened in 2008. Well, it's no good to have a system unless it beats the market. Feel free to criticize me and say my data is wrong. I've triple checked it, but this part for sure is right. I ran a little calculator online. Total S&P 500 return is 149%. If you reinvested dividends, 223. I have a major problem with this reinvesting dividends. I know a lot of people like to use this number, not this number. There's a very famous trader named Meb Faber, look him up online, good podcast, good writer. He thinks this is a joke that people have add in dividends. He makes very, very compelling arguments. He's won me over, but it doesn't matter which one you use in this particular circumstance. You either made this if you needed your dividends to actually buy milk and bread. You made this if you reinvested all your dividends and weren't taxed. Dividends get taxed at some point, don't they? At least that's my understanding. Correct me if I'm wrong. I don't think I'm wrong. Now, how does that compare to our system? Well, if we started with 10K, which is extremely aggressive, okay? Don't have to. I'm not selling you something, all right? I'm not selling you the 10K super aggressive lifestyle. But if you started with a 10K account, you saw what our drawdown would have been, 38.9%. That would be our max drawdown. We ended up with 58,999, right? We had $48,000 of profit. So whichever one you use for the market, that was either 200 or whatever, 150, whatever it was. This is more. No compounding. If you use an aggressive 10K account, if you suffered the exact same drawdown as we did in the stock market this year and a less drawdown than you saw in 2008, less drawdown, double or triple the return from one system built from scratch, okay? Now, even if you use a $20,000 account, you still cut that in half and you still beat the market in the same time period. But that's not all. Wait, that's not all. You could add the other, a couple of friends of the euro dollar, the dollar yen and the pound dollar. Now, these, I did some optimizing. Not that much though. Instead of waiting for 1.5 ATR, they just get in at 1 ATR. So they got in at 80 pips away, 80 pips away. So they didn't wait for what we waited here, just 80 pips away. Here's what the dollar yen produced. This is from 2008, 2020, 25 grand. Here's what the pound dollar. These both had the exact same settings, except they started at a different point away from the weekly pivot. Got it? So if you add all those up, if you traded all three of those at the same time, and they all fit in your margin, then you'd end up with 97,000 of profit. That's a lot more, right? If 48,000 was more, 90,000 is definitely more, okay? And now here comes the fun part. I love doing these exercises. You can love them like I do, or you can think they're ridiculous, but I bumped it up to a $20,000 account, so we're safer this time, okay? And I took, right, just trading them all three, and at the end of each year, if our account grew, then I raised our trade size by the same percentage. And you can see what happens. Our $20,000 account turned into $897,000. That's more, okay? That's definitely more than what the market produced. Sorry, we can go back and look at that calculator all day long, okay? So let's wrap it up. We built it from scratch. We took timeless principles and we built them from scratch. We didn't optimize. Now, I did optimize a little for its friends, but no optimizing. You saw me go through it. Just the euro dollar is better. It's better than the market, right? Portfolio did significantly better. And so here's sales pitch. You ready? I don't offer individual robots. I have memberships for people who want my robots. I trade this and I trade some others. I'm going to offer this because Dave is kind enough to let me speak at these every now and then. It's only $99, and I don't do that. Normally, I only sell expensive memberships. Okay, but there's no link, there's no catch, there's no marketing. You have to email me and tell me about yourself. Why? Because I like that. I like to hear people's stories. I'm fascinated by that. I love a lot of great people. A lot of my friends in my life are traders. So that's the catch. If you want this deal, you got to email me and you got to tell me about yourself. Sorry about that. And then we can talk about getting the deal. My memberships cost $3,000. Again, because of the festival, only $99. Okay. This is my email. It's my name with one T. My name actually has two T's. How dare Gmail take that away from me? There's my Twitter. I have a YouTube channel, and I am on Facebook at Scott Welsh Strategies.